Welcome to the Deep Dive, your shortcut to being well-informed. Today we are taking a wrecking ball to the Q4 fiscal year 2025 results for Hewlett Packard Enterprise.
That's HPE. They reported after the market closed on December 4th.
And it was quite a report.
It really was. I think the challenge for us today is figuring out which HPE we're supposed to believe. Our mission is to really dig into the conflict at the heart of this thing.
Right.
You've got this massive, undeniable success and profitability on one side.
Clashing, really violently, with a deeply concerning weakness in their forward-looking revenue guidance.
Exactly.
This call was the textbook definition of a tale of two quarters. Management was up there talking about this huge transformation, record-breaking margins.
But the market only heard one thing.
Execution risk. The stock's reaction was just decisive and totally negative.
It fixated completely on the near-term visibility, didn't it? Especially around the timing of those big AI server shipments.
Yeah, we need to figure out why a clear win on profit just failed to move the needle at all.
Okay, so let's start with that disconnect. Just the raw numbers. The profitability win was real. Non-GAAP diluted earnings per share came in at 62 cents.
And we should probably mention we're focusing on non-GAAP here because it strips out all the one-time acquisition costs.
Especially with the huge Juniper deal, yeah, you almost have to.
So 62 cents, that blew past the street's consensus of 59 cents by a solid 5%.
And it also grew 4 cents year over year. So a really strong performance.
That's money in the bank. But here's where the story just completely pivots.
The anchor.
The anchor dragging the whole ship down was revenue. GAAP net revenue was $9.68 billion.
And that missed the consensus expectation of, what, around $9.95 billion?
Yep, so a miss of about 2 to 3%, which is noticeable.
And the market, sensing that weakness at the top line, it just reacted ferociously.
It really did. Despite that stellar profit, the stock plummeted over 9% in after-hours trading.
And to put that in context for you, the options market was only pricing in maybe a 6 to 8% move. Wow.
The fact that the actual drop overshot even those high expectations confirms that, this was seen as a big negative surprise, no matter how much profit they booked.
It's like watching a marathon runner. They run the first mile faster than anyone expected.
Right.
But then they immediately announce they're going to stumble through the second mile before, maybe catching up later.
And the market only cares about the stumble.
Exactly. But you do have to acknowledge the one metric that shows this accelerating structural health. That's the annualized revenue run rate, or ARR.
That is the metric. That's the key to management's whole long-term argument. ARR, which is all about that recurring revenue from their as-a-service shift.
The GreenLake platform.
The GreenLake platform. It grew 63% year over year.
63%.
To hit $3.2 billion.
Yeah.
And that growth proves, unequivocally, that the shift away from one-time hardware sales is accelerating faster than people thought.
So you have this dramatic, immediate negative reaction clashing with an accelerating structural transformation. It's a real puzzle. Let's talk about that transformation then, because the profitability drivers were genuinely stunning. This validates everything the CEO has been saying.
It really does. This is where the story gets pretty compelling if you're looking long-term.
It absolutely validates the strategy. The margin performance was, it was record-breaking. Non-GAAP gross margin surged to 36.4%.
And what's shocking here is the jump. We're talking an increase of 550 basis points year over year.
It's a huge leap.
So just for anyone unfamiliar, a basis point is 1/100%. So 550 basis points is a 5.5 percentage point leap in gross margin in 12 months.
A 5.5 percentage point leap in enterprise hardware in a single year.
Yeah.
That fundamentally re-rates the company.
It has to. It means the new high-margin stuff networking software, GreenLake, it isn't just growing. It is crushing the old lower-margin business.
This is the clearest sign of an internal structural victory, even if that top line looks a bit soft.
Precisely. And we connect this to the bigger picture. The balance sheet moves also support this whole structural cleanup story.
They do. Q4 free cash flow, FCF, was very strong, $1.9 billion.
Which was up from $1.5 billion the year before.
Right. But, and this is a key point, FCF for the full fiscal year 2025 actually declined. It came in at $986 million.
That's an important detail. But management seems to be addressing the balance sheet pretty aggressively to fix that.
They are. They're moving to sell their remaining 19% stake in H3C.
For what, about $1.4 billion?
Approximately, yeah. And that move is targeted directly at deleveraging the company. They want to get their net leverage ratio down to around 2x by fiscal year 27.
So that cash injection is strategic. It gives them flexibility, insulates them a bit from the revenue turbulence we're seeing.
Exactly.
So if they're cleaning up the structure, they must be finding some structural winners in the portfolio too. Where are these high-growth segments actually showing up?
Well, let's start with the massive winner, networking, which now includes the Juniper acquisition. The numbers they're just explosive.
Hard to overstate.
Networking revenue, with Juniper included for the first full quarter, surged 150% year over year to $2.8 billion.
And the margin was strong too.
Very strong.
Yeah.
23% operating margin. And management is really hammering home this goal of becoming a networking-centric company.
It's not just the acquisition paying off either. They've already raised the full year 2026 networking revenue forecast by, what, roughly $11 billion?
A massive injection of potential revenue. They're talking about integrating AI-native solutions like Mist AI and Aruba Central.
So what does that actually mean for the competitive landscape?
It means they're building a comprehensive AI-native portfolio that spans, the campus, the branch, the data center. It's a direct, credible threat to players like Cisco.
And it sounds like the integration is going faster than expected.
Much faster than Wall Street models had anticipated. This is structural improvement leading directly to market share gains.
Okay, but then we flip to the server and AI segment, which is supposed to be the market's darling.
And we immediately hit the friction points.
The very ones that caused the stock to sell off. Server segment revenue actually declined 5% year over year to $4.5 billion.
Which is confusing, right? Because the demand signal is undeniable. AI is a huge order success story for them.
The orders in Q4 were huge.
$1.9 billion in Q4 AI systems orders, mostly from large sovereign projects. And the cumulative AI orders since Q1 of 23 are now $13.4 billion. That is a gigantic backlog.
So the orders are there, but the revenue just isn't showing up yet. Why? They called it lumpiness. What does that really translate to?
It translates to complexity and to timing issues that are kind of beyond their immediate control. When they talk about these big sovereign projects, they mean massive government-level deals.
Right. Military, national data centers, that kind of thing.
Exactly. Highly customized. The lead times are extended not just by components, but by the customer's readiness. Do they have the data center ready? The power, the cooling?
So these timing issues directly contributed to the Q4 miss.
And they are the reason for that significantly soft Q1 revenue guide. They're pushing this enormous chunk of revenue into the back half of fiscal 26.
That seems like an issue they should have had better visibility on. The market is punishing them for a lack of control over the timing.
Absolutely. The market sees this as an execution issue, period. And meanwhile, their other legacy business, hybrid cloud and storage, also showed some softness.
Hybrid cloud revenue is down 12% year over year.
But the company is kind of framing that as a good thing.
As a deliberate choice.
Right. It reflects a strategic pivot. They're actively stepping away from lower margin, non-IP businesses where they just resell somebody else's hardware.
And focusing on their own stuff.
Exactly. The positive sign there is strong demand for their proprietary Electra MP storage and pretty solid growth in private cloud AI orders. They brought in about 100 new customers this year.
So now we get to the core of the market's pain. The guidance. You have this phenomenal margin momentum being completely overshadowed by a truly weak near-term outlook.
The weak Q1 fiscal 26 revenue guide of $9.0 to $9.4 billion, that is well below the consensus, which is closer to $9.9 billion.
And that soft top-line number is the singular reason for the stock's massive sell-off.
Yet, and this is the paradox, management raised the full-year FY26 guidance.
Which raises the big question for you, the listener. How can they raise profit targets when the immediate revenue looks so soft?
They lifted the non-GAAP EPS outlook to between $2.25 and $2.45.
And the free cash flow guide was raised to $1.7 to $2.0 billion. The answer they give is all about timing and component availability.
Correct. Their guidance is leaning very heavily on the second half of the year. They're expecting 54% of revenue and 53% of EPS to land in the second half.
Wait, hold on. That's management basically saying, trust us, over half the earnings are coming in the last 6 months. Isn't that the exact definition of execution risk that the street is punishing them for right now?
It absolutely is. That dependency introduces a massive amount of risk, and that's why the market sold off. And adding fuel to that fire is the commodity headwind.
Right, they talked about rising DRAM and NAND costs.
Essential components for servers, and their response, price increases.
So they're just going to pass it on.
They implemented price increases in November. They expect to pass through most of these costs, but here is the big risk with that.
Demand elasticity.
Exactly. The structural question is how elastic is demand? To simplify that jargon, if HPE raises prices too much, will customers just sit on their wallets and wait 6 months for prices to stabilize?
That could undercut their unit growth, even if the total revenue number holds up.
That's the risk. And yet management maintain their ambitious long-term targets. They're still shooting for non-GAAP EPS of at least $3 and free cash flow over $3.5 billion by fiscal 28.
They're betting the structural improvements will trump the short-term turbulence. The key takeaway is the market is trading the certainty of immediate pain over the promise of future profitability.
And that takes us perfectly to our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea based on all this conflicting data.
Okay, the thesis here is pretty simple. The market overreacted. It reacted violently to the Q1 lumpiness and the weak revenue guide, and it completely missed the forest for the trees.
The Juniper integration synergies are accelerating.
The margin framework for fiscal 26 is actually raised.
And the company is structurally de-risking by monetizing that H3C stake.
So we propose a catalyst-driven paired trade. We're betting on the spread created by HPE's transformation versus a peer that just doesn't have that same structural strength.
So the first part of that is the long position.
The long position. Go long HPE. We are banking on the raised FY26 EPS and free cash flow guidance, plus that anticipated $1.4 billion cash injection from the H3C sale.
That cash accelerates the deleveraging.
Yeah, gets them to that 2x target by FY27. This disciplined margin expansion and cash flow provides a huge safety net against the AI server volatility, and the valuation is now much better after the sell-off.
And the other side of the trade, the short position.
You short a pure play, lower margin, traditional server or hybrid cloud hardware vendor. Think, hypothetically, a peer with less than 30% gross margin and no meaningful software ARR.
And the rationale there is that HPE's aggressive pricing actions, because of those DRAM and NAND costs, will ripple across the whole hardware sector.
Exactly. But peers that don't have HPE's diverse, high-margin networking and software portfolio will have no way to absorb that elasticity risk.
They'll be forced to either eat the costs and crush their margins or raise prices and lose volume.
While HPE can pass them through because its portfolio is more differentiated, we capture the spread created by HPE's transformation using the market's current disappointment as our entry point.
Okay, so let's summarize. HPE successfully executed on margin expansion and that crucial Juniper integration.
They're laying the foundation for a much stronger, structurally higher margin business. That is the internal success story.
However, the market penalized the stock severely. It was all about the disappointing revenue guide and that significant lumpiness risk with the AI deals pushing to the back half of fiscal 26.
So the key conflict for you, the listener, remains. Can the structural improvements, the synergies, the cost cuts, the mix shift reliably carry earnings higher?
Or will macro risks and AI shipment timing just consistently undermine the top line and management's credibility?
And here's the final provocative thought to leave you with. Management is framing 2026 as the year HPE becomes a networking-centric company. Given their projection that networking will now drive more than 50% of the company's total operating profit for FY26, what does this fundamental shift mean for the perceived long-term value of the traditional cyclical server business? Is that segment now essentially just a financing arm for the new high-growth networking identity?